Hey everyone, welcome. We're just going to wait a couple more minutes for a few more people to join. Room's filling up quite quickly. Don't want to waste too much time here at the beginning waiting for everybody, but want to make sure that those who are running a little bit behind have an opportunity to make it from the beginning. Just as a reminder as well for people who are already on, there's an opportunity, obviously, to ask questions. I'm going to try to ask as many of those questions live for Brian and Emmett as we go through their presentation. But as well, also, we'll get to hopefully the remaining questions at the end. We've got everybody's questions who sent questions through prior, but live questions we'll also try to get to. So feel free to use that question and answer functionality here within the webinar to shoot questions over sort of as they come to your head, or if you've been sitting on them as well. And with that being said, I think it makes sense to jump right in. For those of you who haven't been on one of our webinars yet, my name's Simon. I'm one of the two CEOs here at Humi. With me today, I've got Brian McLaughlin and Emmett O'Kane. They've both been longtime Humigos, as we call them. Brian and I actually go way back. Used to, once upon a time, live on the same floor of an apartment building. Brian, though, brings with him meaningful, very deep benefits experience. He's the leader of our benefits division here at Humi. He was a VP at Benefits by Design prior to becoming a broker by himself, and then coming over to Humi to lead our division. Emmett, newer to the industry, but also quite valuable in terms of the experience that he's had, boots on the ground, working with our clients to manage the current situation, as well as just broadly helping people to either save money or implement great plans. For those of you who don't know us whatsoever, Humi is an HR, payroll, and benefits software company. That benefits component isn't only software, it's actually mostly the people behind the software, as we're a nationally licensed benefits insurance brokerage. If you haven't looked at our software yet, definitely check it out. But other than that, I'll leave it there. I'm not the one who knows much on this call compared to guys like Emmett and Brian, who can hopefully share some really meaningful insights here today. So with that being said, I'll pass it off to Brian and let him run through the presentation, and I'll only jump in to bug him with questions.
Perfect. Thanks so much, Simon. Hope everybody brought their sunglasses, because I can't avoid the pot lights in my room here and they're shining off of my head. But we do appreciate you all attending today. Seeing the list come in, and a lot of familiar faces, but certainly some new ones. So we hope that today, you find that this is really insightful. We're in an unprecedented set of times here where there's some really weird things going on. Emmett, myself, the rest of the benefits team have been, for lack of better terms, bombarded with questions that we're just frankly not used to getting. We've learned a lot over this past month and a bit, and really today, like I said, we want this to be insightful for you. We'll be focusing obviously on premiums. There's been a lot of changes around that, and really just putting this in a position where you can leave saying, hopefully you learned at least one thing, maybe some things were refreshers, but ultimately we want you to be that professional at your workforce where you can make sure that you're arming your staff with the most appropriate resources that are available to you out there. As Simon mentioned, for anyone who maybe joined late too, we'll be sharing this afterwards. And I think the key disclaimer that we always have with benefits is, we get asked these seemingly simple questions, and they are relatively simple to answer, but I hate having to say this all the time, but I'll say it again, it depends. And what I mean by that is that with the landscape that we live in the benefit space here in Canada, every carrier approaches things a little differently. So we will try to be as specific as we can throughout to today, but ultimately, as you were asked with your inbound questions beforehand, knowing your carrier will really allow us to drum things down a little bit further. So if we can't answer it specifically today, you have our commitment that before the weekend, we'll get back to you personally. There's already been a couple where I know Chloe, who's been facilitating things, will make sure that we are able to be in touch with you directly. So, we see this breaking down into a few different stages really today. The first is a retrospective. It's things that we do kind of already know. We then will shift into the shift to virtual. Obviously, everybody working from home, we've been all leveraging things that we maybe weren't accustomed to before, maybe we knew about, but certainly now we're trying to really take advantage of. And then where the majority of the time today is going to be spent is on the third stage. It's really looking and thinking about the future. What this might mean for your business could cause you to totally shake up the way that you approach benefits. So we're going to chat a lot about that towards the end. But again, that'll be the majority of the time. At the end of the day, as we shift into what we already know, we obviously did do our research in preparing for today. And that research was really, chatting with some clients, but also HR professionals. So this retrospective, I'm going to go pretty quick, and that is intentional because what a lot of the HR consultants specifically said in working with their clients is that we already know a lot of this stuff. We're basically, let's say 6 weeks or so, 5 or 6 weeks into COVID-19, and a lot of this stuff was addressed quite rapidly. Emergency travel coverage especially. I mean, ultimately, it's tough to go anywhere to begin with now, but for some essential work travel, insurers are willing to make some exceptions. But if you were to drive across the border today, ever since that advisory by the government on March 13th, I believe it was, you're likely not covered. So let's just make sure that we know that, and if you have to go somewhere, we can certainly facilitate those conversations with your insurer. If week number one was travel,
I just want to jump in just for a second there, because it seems like something that is the most known item, right? As soon as this happened, it was probably the number one thing that came across our plate in terms of questions with regard to people who were traveling. And that date of March 13th was a really important one. I actually have a friend who had left on March 12th, just processed a claim. Luckily, they were on sort of the finish line in terms of where those claims were being allowed to pass. But what's your personal outlook on where this is going to move in the future? What is that process? You mentioned reaching out to a benefits broker. If you do have essential travel, either personally or for business, what's the process right now for making sure that you're covered?
So some carriers have a lot more leniency, I guess is the best way to look at it. Whereas others they're taking a hard stance. They are very risk adverse. They don't want to put themselves out there to have to cover claims. It's why a lot of people dislike insurance companies. They try to find every way to not pay a claim possible. Whereas again, some of them, maybe they have older contracts that they've just chosen not to update. But for whatever reason it may be, some of the carriers are willing to say, you know what, we're still willing to cover people. So at the end of the day, even when we do a general employee education session pre-COVID-19, specific to travel, we do education sessions and say, if you're going away and you have the slightest inkling that something might be up with your health or where you're going, it's best to be proactive and contact your insurer and or us, your advisors, beforehand, and we'll help navigate that for you.
And it sounds like it's also it depends situation as to what carrier.
You said it, not me.
All right, I'll let you go on because these are supposed to be the quick hits.
Sure. So I guess what I was going to say is that, if week one was travel, week two and still today was the layoff provision element. So again, it depends, but there has been leniency in this space that I've never seen in my decade plus of doing this. So how long carriers are willing to extend the benefits, what the responsibilities are as a plan admin, you really should know those if you're laying off people. Primarily, it's making sure your carrier knows, understanding what the timelines are, and again, those vary. What the reinstatement requirements may be. So obviously, when you're bringing people back to work, those are all the kind of things that we have established a resource online to help address some of these FAQs. But again, if you want to get into specifics on your carrier, we can do so. Next, benefits suspensions.
I'm gonna keep jumping in because these are hot topics for sure, and we have some questions from some of the people on the calls here today. On layoffs specifically, and I know that this one might be a little bit out of your realm. one person on the call asked a question about um, if you're laying people off on a temporary layoff, typically the mandate is that you continue to pay for that person's benefits. They're still technically part of your team. Can you make changes to those benefits plans while they are laid off, like reducing their benefits in order to save you money? I know this is more of an employment lawyer type question, like would you be breaching any type of employment law provisions? But do you have any knowledge in that sphere?
So I certainly would exercise caution in my response on the labor lawyer side. However, at the end of the day, like plan sponsors, they do have to abide by the legal ramifications that are put out there. However, as a plan sponsor, you can amend your contract at any time. So, it's always worth having the discussion beforehand, but ultimately, you can't pick and choose who you might be changing coverage for. The whole class structure and
say, is that changing class structure would be something that I would assume would raise a red flag. But if you have a single class across your entire group, making a change that affects the entire group probably would be seen as kosher or above board.
In many cases, yes, but again, I think that you always want to exercise that caution and making sure that you're doing things the right way.
And actually, on that note, just as it relates to the legal ramifications of changes in benefits, we did host 2 webinars a couple weeks ago, back to back with the same legal professional who focuses on employment law. He's somebody that we definitely recommend. I forgot to mention it earlier, but we've been producing a lot of resources to try to help however we can. Somebody from our team will post a link there to review the webinars that we had recorded that covered legal topics. That question kind of touches on some legal components. And if we don't cover your questions there as it relates to anything legal, would also recommend reaching out to Nathaniel, who's featured in those webinars.
Perfect. So to kind of carry on just with this one, benefit suspension. So this has probably been one of the number one things people have been reaching out to us about is what can I and can't I suspend or put on pause? Most common example, dental. I mean, unless there's an emergency need like a root canal, dental offices are closed. So people have been reaching out saying, hey, let's put this on pause. And we'll get to benefit suspensions a little bit later, where I'll go into a little more depth on that. Many carriers, if not all, have been willing to either defer renewals or allow for a little more relaxation around the timelines you have to provide payment before they put claims holds on there. But specific to those renewals, we're seeing typically anywhere from 1 to 3 months. And then I already referenced it. We have built a couple resources, which we'll provide links to throughout the presentation. One being on just, the FAQ type of stuff that I'm, again, glancing over relatively quickly based on the feedback we were given building this presentation. So if you're not comfortable or clear on anything regarding your carrier, we want to talk to you. We hope that you look to us as a resource, and you can certainly reach a member of our team. It comes to all of us. Some of our older clients might be more familiar with brokers at humi.ca, benefits at humi.ca. We'll get you to the same place.
Brian, just before we actually move on, we got a question that's live here that relates to travel. So I think, when you were referencing that date, March 13th, and leaving, I think that you were specifically referencing travel coverage. So like the idea of travel interruption coverage or extended medical that would cover you while you're traveling. Somebody on the call has somebody who's left after that deadline, so March 18th. How does that impact the rest of the benefits plan? So are they still covered for life and those other components that aren't related to travel, or would that in fact put them in a breach of their entire plan and coverage?
No, so I was being explicit in discussing the emergency travel benefit itself. So leaving after the federal advisory, in many cases, will have put that person in a position where their medical coverage cannot be guaranteed, and unfortunately likely is not going to cover them. There are carriers who are not so concerned about it and are allowing that travel and allowing it to be covered if an emergency medical need arose. But again, I was explicit in the emergency medical benefit.
So the balance of benefits would still remain active.
Yeah, I mean, you can't use your extended health and your dental benefits out of country, but yes, everything else would be fine.
Okay.
So that then brings us to our virtual reality. I wanted to have someone with a VR headset on here, but didn't squeeze it in. So, anyways, the reality is, like I mentioned in my opening, we are finding people trying to find other resources that they may have heard about, but they haven't necessarily taken advantage of yet. So we've had a lot of these inquiries where we're just really trying to again point people in the right direction on how people can address specific needs. So. When this all began, couple different provider types were pretty quick out the gate in providing free COVID-19 screening. Now, just Google it. There's so many of them that if you haven't already made your staff aware of it and they're worried they might have caught it, they can certainly do some screening online, whether it be the government or other virtual practitioners. We have in the past, for many of our clients, you'll probably recognize me, especially talking about central dispensing pharmacies. There certainly are other economical options like Costco. But at the end of the day, if we haven't had this chat, this is something that certainly will just force people to finally try this stuff out. They're safe, they're convenient, they're affordable. They have lower markups and lower dispensing fees. So at the end of the day, it's going to cost your employee less and it's going to cost your plan less if people are actually using these things. And they'll deliver it to your doorstep. So it really is a virtual experience.
Yeah, that's what I was going to highlight. So a central dispensing pharmacy is effectively a virtual pharmacy that's doing 100% delivery.
Correct. So
when you mentioned Costco there, do they do delivery?
They do. So,
and do I have to be a Costco member?
Great question. So no, you do not. So anybody can use Costco pharmacy. Anybody can use a central dispensing pharmacy. Those not familiar with central dispensing pharmacies, they're a licensed pharmacy. They just don't have every brick and mortar on every corner to walk into. Licensed pharmacists on staff. And they basically, because they have less overhead, one as an example being Alliance Pharmacy Group, there's only 3 in all of Canada. They take that reduced overhead and they pass the savings on to you. They deliver free of charge via FedEx next business day. And again, their dispensing fees and markups are dramatically lower than here in Ontario walking into Shoppers Drug Mart where it's about $14.
Can everybody access these pharmacies or do you have to have a benefits plan that would give you special access?
My dad has no benefits. My dad uses it. So anybody can use them. They're certainly not specific to benefit plans.
Okay, awesome.
Then, to kind of get to the final 2 points on this slide, I mean, it's been a great opportunity for my team to learn. It's been a great opportunity for us to really take what we have been loosely promoting and really drive it home and make it resonate with a lot of clients. Virtual medical is here to stay. They certainly have proved their value over the past month and a bit, where us at Humi, our benefits plan, we are lucky to have a company called Acura embedded in our benefits plan. 24/7, we can visit with a nurse practitioner from our computer or our phone, laying in bed with my 2-year-old son, 3 a.m., wondering if we need to go to the ER, that kind of stuff. Now more than ever, people want to be able to have access like this. If this were 6 weeks ago, we'd be singing a different tune. This market, this industry is nuts. They are changing every single day, multiple pivots. And again, we've got another link here for another resource. We're going to do our best to keep it as up to date as we possibly can. It's hard to keep pace with it, but there are free options. There are group programs that obviously have a cost. So the free options, great example would be a company called Tia Health. Again, us being here in Ontario, someone could use Tia Health and that can be submitted through OHIP. Same thing goes for BC Pharma and many other provinces. So there are free options available. That 6+ weeks. Pardon me?
The majority of these, like Akira, for instance, would typically come with a monthly fee. Maple, that would be another that would typically come with a monthly fee, often covered by employers, but in some cases covered by benefits plans.
Yeah. So again, it's the good old depends line applies. The link that we have here will give you some more info because a provider like Akira traditionally has only been offered through the corporate channel, through group plans. On one-off basis, people could access Maple. Maple is one example where they've partnered with Shoppers and they're allowing the screening for free. And I've heard a couple unfortunate circumstances where people thought everything was free. They got on with a doctor and then they were billed. So it's just important, again, to understand what free truly means. Coming back to the group programs, and I'll kind of get through this a little quick here, but the advantage to going with a group program is really an enrollment standpoint, and having the ability to enroll someone in your group plan and know that they're automatically going to be put onto the virtual health. Whereas if it is a one-off, there might be a little more administrative responsibilities on the plan admin. But at the end of the day, I have heard some really great feedback from Tia Health, specifically being a free option available to any Canadian. So who knows what's going to happen after COVID? Are they going to shift back to a pay-per-use model? I don't know. We're going to have to wait and see. And then when it comes to those group programs, you'll probably see a per employee per month cost. It's going to depend on the relationship that the virtual provider has established with your benefits provider. Costs vary. Even for Akira, for example, working with many carriers, I've seen different cost structures. They also, in some cases, will have a pay-per-use on the employee side. So for example, we have one provider we work with where it's a very low per employee monthly cost on the group benefits invoice. And then every time someone uses it, that employee is responsible to pay $10. That can be submitted to their HSA if they have one. Some have chosen to build it into their actual insured health plan, where you could submit up to, I don't know, for example, $100 eligibility on the virtual medical program. So again, it depends. There's a lot of different structures out there, and it's changing quite rapidly. To wrap up this slide then, virtual health does naturally just weed into mental health. And it's something that probably is the number one thing plan sponsors are wanting to address. We're in this weird space where I love working from home, and I have always done it quite frequently, but I'm not the norm. A lot of people are struggling with being at home, being isolated, especially single people. They aren't feeling awesome. There's no hiding that, and it's natural to not feel well and maybe want to reach out and have someone to talk to. So there are a lot of different providers out there that are also included in that virtual link that we've got on this slide. So we encourage you to get familiar with the options out there. One that we are very familiar with is Inkblot Health. They are a virtual mental health provider, and ultimately what they've chosen to do is they typically have a $50 access fee for an employer to pay and to say to all their staff, you can use us. They've waived that until June 30th, understanding that people need this type of help more than ever. So from a corporate perspective, it's free. Then once you're on Inkblot, sticking with my example here, employees can visit with psychotherapists, mental health practitioners, and that is eligible under your paramedical practitioners. So there would be a cost per visit to the employee, but they're eligible to submit that to their paramedical coverage or their HSA. The key value to Inkblot in this case is that they are on average 50% the cost of going and sitting on a therapist's couch. These are practitioners who have a minimum of 5 years experience. They've chosen to be a part of Inkblot's network, and they're offering their service at a reduced price because Inkblot is then arming them with billing and booking technology that they wouldn't have elsewhere. So it's a great strategy. It's free for the employer to promote this and offer their staff that resource. Question, Simon?
So yeah. Coming back to this just as a broader theme, one of the people on the call here today had a question about adding extra benefits. Obviously, this theme of mental health support and therapy is a really important one right now, as you mentioned. I think you kind of touched on it earlier, but do you think it's worth clarifying? If somebody wanted to add extra benefits just in one area like therapy, can you target that? Is that, again, a carrier by carrier basis? How would you go about it? If you wanted to get more dollars into the hands of your employees to access therapy, what's the best way to do that?
Good question. So ultimately, the answer is yes, you can. To take it another step further, a couple questions I've had has been like, can I just shift where I'm spending things? So the next slide, we're going to get into plan amendments. So I'll save that part for there. But I mean, you can always add things. The reality is most people don't want to spend more right now. So it's a matter of how do we get from A to Z in that example. Again, that's where it will depend on the carrier on what approach they have to this. It could be something as simple as just adding an HSA onto your existing plan and saying, hey, you can go and you can see these practitioners. That's a simple solution. But at the end of the day, no matter which way you look at it, if using your example there, Simon, I mean, people are asking to amend the plan.
Yeah.
That's how you provide more of those dollars. And again, we're going to get there in a second. So
okay, yeah. So then I'll say there's some connecting questions there, but I'm assuming you might tackle some of them, and I'll let you dig in on amendments because it's a huge one.
Sounds good. So really, I think that what COVID-19 has taught us, I mean, I'm not foolish enough to think that this is the new norm forever, but studies show that this likely isn't our only bout with this. It may come back towards the end of the year, who knows? So I would pose the question to everybody here today, do the traditional paramedical practitioner structures that you've grown accustomed to, that we've seen for a very long time here in Canada, do they still meet your organizational needs? And I understand it's very simple to answer that one. Like in today's reality, the answer is probably no in some cases, because paramedical dollars can only go so far to see a mental health practitioner. But I guess the reason we pose this question is there is an opportunity here to do a bit of an overhaul, or at least reconsider different ways to approach benefits. So I will be at that stage of the presentation in just a couple more minutes. So the effective options that people have today, you can leave your plan as is. And that has, in the end, even though we've gone out and repriced certain things for amendment considerations, that has been the way most people have gone. A few of the questions that did come in beforehand is, are there going to be any discounts? So if you haven't been paying attention to the emails from your carriers, or you haven't got one yet, they're imminent. Or they're already in your inbox, maybe your spam, because starting on Thursday night of last week, all the way up until there was another one that came out today, the carriers have unified in a sense, and they are providing premium credits. They understand that you can't go to a dentist in most circumstances. You can't do every type of paramedical practitioner visit that people may have grown accustomed to, like massage therapy or chiropractic. So premium credits are being applied, some retroactive to April bills, in most cases starting in May. And I've listed just some ranges here for people. But at the end of the day, another link for you, another resource we've built where you can go to this link, you can scroll through to find your carrier, and it's something that we will make sure that we continue to update. Some of them are doing it for April, May. Some of them are extending it to June. Others are only doing it for May and treating things on a month by month basis. So again, that will depend on who your carrier is. So at least we're seeing some reductions, because a lot of people were saying, hey, can we reprice this? Unfortunately, that's not the way underwriters approach this stuff. It's based on historical claims patterns, and 1 month really wasn't an effective snapshot.
And so coming back to it, if you leave your plan as is, certain carriers are providing some relief. If not, the option would be to make plan amendments, which we're going to get to next.
Yeah, that's on the next slide.
Okay.
So we are finally almost there. But at the end of the day, we acknowledge that not every business is the same, and certain industries have been hammered with this where others maybe are doing just fine in a sense. So for those who really, you really need to focus primarily on cash, there are the ability to suspend some of your benefits, if not all of them. Again, carrier by carrier, but you do have the ability to essentially push pause. And that's great for a lot of our clients, because right now they need to conserve cash. So we can help facilitate that with your carrier. And at the same time, we would always, as advisors, want to make sure that you understand the implications of doing so. Earlier, I referenced the root canal, an emergency dental type of claim. If you had someone in that circumstance, depending on your corporate philosophy, would you want them to have to fully pay for it out of pocket? Because if the benefit is suspended, they're not going to be able to submit that claim once things come back. So We would just want to make sure that we're crossing every bridge here to make sure that before you make that decision, everything's clear. And again, depending on the carrier, even if you have stuff suspended, you might have some other solutions out there, things like Cost Plus, where you could submit those claims. So if you want to have those discussions, please let's have them.
Before we move on to the next slide, just a question back to sort of this concept of premium relief or premium credits. Obviously that impacts traditional plans where you're paying for insured coverage. But if you have an HSA, either as an add-on or your entire plan is supported by an HSA, are there any changes that we're seeing? We've got a couple questions that relate specifically to just that as a general subject, but also, changes in carryover rules or policies. Any recommended tactics in order to help employees take advantage of their HSA in regards to this concept of, so many things covered by an HSA you just can't access right now? What's the best way to accommodate for that?
Well, I mean, to be a devil's advocate, I think that having an HSA is probably one of the best things possible for employers right now, because that's money that the employee isn't necessarily, restricted. So for example, with $300 per practitioner as a paramedical maximum, if you've got $1,000 spending account and you haven't really used much of it and you really want to see a mental health practitioner, you have the ability to use those dollars and go to something like Inkblot. We did see that one. I think you're probably referencing one of the specific questions that came in advance around an HSA program that didn't have the 1-year carry forward provision. And I believe that particular question stated that their year, their annual allotment expires on May 31st. They were asking, can we change it? By all means, if you don't have the carry forward provision and your plan is nearing its anniversary where unused funds may be exhausted, by all means, let's chat. Let's get on an email chain or a call with your carrier to make an amendment there where you could allow unused dollars to roll forward during these unprecedented times.
So for me, my understanding of what you've said and kind of my understanding going into this actually is that HSAs, there isn't any HSA provider who's providing relief the way that the traditional plans might be providing relief. And as a result, if you're running with an HSA and looking to find ways to improve the plan, save costs, improve benefits to employees in whatever way, shape, or form, it's going to be through a plan amendment, either pausing the plan, and people are unable to use it, you're paying like a monthly fee, and you're trying not to pay that monthly fee, you'd have to pause your plan entirely. And if you're trying to extend the amount of money or extend a carryover date, you'd have to make a change to your plan in order to change that carryover date yourself.
Yeah.
Okay.
So again, if you have the use it or lose it, we tend to call it, where unused funds are exhausted and then a new year allotment starts and you want to explore that 1-year carry forward. For those who aren't aware, CRA allows you to carry forward unused funds for up to an additional year. So if we stick with a calendar year example, unused funds from 2019 could still be available for the 2020 calendar year. But if the 2019 funds weren't used by the end of 2020, they would expire. So I've said I'm almost there a couple times, talking about plan amendments. I think it was worth putting this into our presentation here. We got some good data from Equitable Life, one of the largest group insurers in Canada, that as of last Wednesday, 99.1% of their block had actually remained unchanged. So again, it seems like the majority of people are remaining optimistic and sticking with it. And as I referenced earlier, if you do want to explore changes, we can do that for you. We can get repricing done to amend your plan structure. But I would always, again, have that risk discussion and ask yourself a few questions here. So how long are amendments taking with my carrier? So if I'm the plan sponsor who's saying, okay, let's just change things for a month or so and then go back. Well, amendments usually take 3 to 4 weeks. Now we're seeing those timelines double, if not slightly below. So if your intent is just to switch back, you're not going to see the premium relief. Your employees aren't going to be able to make claims based on the different plan structure before the time that you want to revert back to what you have today, if that is your plan. So it's going to be case specific. We get that, but it's a good question to ask yourself. Also, some carriers have said that they will make you wait until your renewal to revert back to your current plan design. There's very few of them, but it's a valid question that we just want to make sure we cover off if we're going to go down that path. And then if you don't need to wait until your renewal, what's your carrier going to do? Are they going to just say, okay, you can go back to your old rates, or are they going to re-underwrite you? So if you're a group that's had claims experience that's trending on the high end, being re-underwritten would certainly not have a positive effect on premiums. So again, just let's cover these off together to make sure that when we're making a change, it's for the right reasons. Any questions that came in on that, Simon?
Yeah, no, not specifically. I mean, a lot of people definitely asking questions about making these types of amendments. And I mean, I'm shocked to see that number at 99.1% of people who have not made changes yet. But given a lot of the context and the questions that are being asked, it sounds as though, people didn't even know that this was a possibility. And so it sounds as though more people should be getting active and thinking about how to make these changes, and then digging in with their broker, whether that's us or you have a different broker, to work with carriers to figure out what the implications might be if you do change the plan.
Yeah, perfect. And we're about 20 minutes from the full hour. I mean, we've had a lot of questions as we go. I hope that, Simon, those are coming through the channel here. We'll try to address as many as we can, but I'm just going to move on here. So really, or in my opening, I think that this is an opportunity to be strategic. People, I guess, questions are coming in, people wondering about amending their plan. This isn't going to be necessarily for everyone to go to some abrupt change, but you may want to explore slight changes. So if you don't know this, you can amend your plan at any time. And if you're with a carrier that isn't allowing you to accomplish what you want for the future for your plan members, you can terminate your plan with 30 days notice at any time. So that's often a misconception. People, I think about their liability insurance on their business sometimes, that they're locked in. It's not the case with benefits. So if you do want to explore some things and your provider isn't willing to get you where you need to be, we're your advocate first and foremost. So if a change is what makes most sense, as long as we're able to, we'll do that for you. So again, coming back to just being strategic, we do think that COVID-19 can act as a catalyst. Some companies may want to stick traditional, but there is this ability here to really reevaluate things. We've got a lot of groups who have achieved some real plan sustainability through what I call a hybrid type of plan, where it's covering catastrophic things like drugs, hospital, travel, combining it with some basic dental coverage, and then layering on some form of flexible spending, whether it be a health spending account, which is still a tax-free to the employee benefit, or a lifestyle or a wellness spending account. One of the questions that came in, or was more of a, just make sure we point out that these are two different things. One is taxable, the other is not. Health spending account is governed by CRA. It's eligible medical and dental expenses. When it comes to taxable spending accounts, that's things like, yoga memberships, buying a bike, new pair of running shoes, that kind of thing, which would still be a taxable benefit.
But coming back to it, because that is an important one that, until recently I didn't even fully understand. The list of things that would qualify for an HSA, that's actually available on that's a government directed list. You mentioned the CRA. Is that where you would find that list of things that are covered by an HSA?
Yeah, and even prior to COVID, we do have a what we call the Help Center. We have an article on that, but we're really hesitant to provide our own list because CRA does make changes quite regularly. It's really hard for us to keep a list up to date ourselves, so we do just tend to say, here's the link. And yes, the link it's searchable. It's CRA actually had a pretty decent site with this to be able to find are things eligible, or are they not? But it is solely governed by CRA.
And things like professional mental health resources or support are typically covered by an HSA because those would fall into that category so long as they're licensed mental health practitioners. And again, those lifestyle accounts are then more so for things like yoga or travel or commuting or exercise, whatever it might be.
Exactly. When it comes to those taxable ones, it's carte blanche. It's more common for employers to say, what don't we want to cover? because it could literally be anything.
Okay. Yeah, that's good to know. Good to clarify.
So part of this whole getting strategic is, we've got a workforce we really haven't seen before. The demographics that comprise of the workforce are spread so far now that people have differing needs. So having things like spending accounts, it really does promote flexibility, creating more engagement with your employees, which ultimately is what we're here to do. We want employees that are happy at your organizations and feel like they're being taken care of. So I am going to pass this over to my colleague Emmett. Emmett, as Simon mentioned, he's a senior advisor on our team, and he'll just kind of take us through understanding the cost of insurance, which I think will shed some light on everything that I just talked about on the last slide, so that we're really wrapping a bow around just things you may want to consider on a go-forward basis, given that we are being forced to reevaluate the way things are structured.
Yeah, thank you, Brian. So yeah, at the end of the day, we want to be able to get strategic with the plan, and we want to control the insurance cost. So really, in order to do that, the problem is that many individuals don't really understand what they're paying for within the benefits plan, within the insurance plan. So without that understanding, it's very difficult to adapt and control the costs when there isn't an understanding of how the cost works. So in thinking about, the first thing is that the reality is that insurance is about spreading risk, or group benefits is, yes. But when it comes to the experience rated benefits, your extended health care, your dental, at the end of the day, over time, the claims get paid for via the premiums that you pay. Insurers are not in the business of losing money. And over time, those claims do get paid for through premiums. So we need to understand then what cost is built into the premiums. Well, really, all the premiums that you pay are on a monthly basis is paying to fund the claims, and then adding in the cost of insurance. So some groups will say, we want to control the cost. How do we do that? Well, we can lower coverage. We can restrict the coverage. That's obviously going to lower claims, and that will save us money because there's less risk. Or we can take the secondary approach, keep the plan the same, not scale back the coverage and what you're offering employees, but control the cost of insurance. So, question is, what's in the cost of insurance? Brian, if you wouldn't mind just jumping next slide. The first thing really is the TLR, or the target loss ratio. This is referring to the insurance company's break-even point. We need to understand this. So in this example here, if the TLR is 78%, for every $100 that you're paying in premium, $78 is going to fund the claims. Meanwhile, you've got $22 that's going into the pot to pay for the insurer's expenses. That $22 is the margin that the insurer requires in order to break even. So the higher that target loss ratio, the more your group can claim, the area in blue here on that graph, before an insurer recognizes a loss. Of course, when insurers recognize losses, we've seen this before, they increase rates to recoup those losses.
And so, coming back, I don't mean to break it here, but I think the simple way that I think about this is this is the markup, right? This is the amount that your insurer is marking up the claims in order to cover their own costs for whatever reason. It might be to make more money. It might be because they have a structure internally that requires them to mark it up more. But in any case, if your target loss ratio is lower, then you're likely paying more because the carrier margin is higher.
Yeah, really, it's their margin that's built into the plan. You might think that, well, we paid $10,000 in premium over the year, and our group claimed within health and dental $10,000, we broke even. That's, of course, not the case because the insurance company's taken on all the cost of the risk, the cost of administration, and everything else. So they require a margin in there to break even. So end of the day, the higher the target loss ratio, the better position you're going to be in at every single renewal, because that's what your rate increases or decreases are based off of. So really need to understand that first point. Thanks, Simon. So the second one then is the pooling fee. And this is built into your extended healthcare rate already. You're already paying for this, and it's the portion of your premium that covers the insurer's pool for high-cost healthcare claims. Thinking items like specialty medications that are high cost, exceeding $10,000, $15,000 a year, or emergency travel claims like Brian alluded to. So you're paying for this already. This, depending on what that fee is, you can see different amounts on that graphical representation. This is also lowering the amount of what you pay that goes towards funding the claims.
Would you ever see, and this may be a tough question, but because a lot of these things I don't understand the intricacies of either, would a higher pooling fee be correlated with like a better program ever, or is it typically you're getting the same thing just paying a different amount?
No, it certainly can be different depending on the program, depending on the provider, depending on the plan, absolutely. It really is dependent on the performance of the insurance company's pool overall, because that pooling fee is going towards funding the pool to cover those really high cost healthcare claims that insurers aren't trying to recoup from you each year through renewals. So we really want people to have an understanding of what their pooling fee is, what they're paying, and how those can be really quite different depending on the plan that you're on.
Things like TLRs and pooling fees, are they typically static year over year for somebody? Like if you sign up for a plan and you got a TLR of, call it 80% and a pooling fee of 12 or whatever it might be, is that going to be the same this year and the same next year and just get applied to your plan on a go-forward basis? How often does that change?
Yeah, they can be reviewed. Brian might want to hop in here too, but they can be reviewed depending on the plan that you're with, depending on growth of the company, size of the company, that type of thing at each renewal. So, I mean, it's really important that not only you're considering the bottom line cost and premium that you're paying, but what those financial factors, we'll call them, are that's actually built into the plan. And that's what's going to dictate how your plan performs over the course of the year and what increases or decreases will look like at renewal time. Yes. So that last one then, the last one to consider is around advisor commission. So this is the percentage of, again, premium that you pay that is going towards an advisor's compensation, which of course, depending on what that percentage is going towards the advisor's commission and is knocking down the amount of funding that's going towards paying the claims. So again, when it comes to extended healthcare and dental, the cumulative cost of insurance, as you can see on these graphs here, depending on which insurer that you're with, can run up to 30% or more of what you're paying in premium. These are, of course, just graphical representations, but if you were to claim the same as you paid in premium, this area in blue, is how much is actually going towards the claims versus the insurer. So the insurer on the left here is going to recognize a far greater loss than the insurer on the far right, putting you in a best case position in negotiating what your renewal rates would be going forward.
Yeah, so like the way that I look at this is that if you look at the mid bar and assume that your claims were at that level, sort of the dark blue all the way up to the middle, if you were with a carrier or in a structure that was on the left, they'd be increasing your claims the next year. If you were with a carrier with a structure on the right, your claims would be the same, if not, maybe getting a reduction.
Yeah,
do that. And so this really, really matters. This is the backbone of what's driving that. Another interesting thing, coming back to commission specifically, what's the status of the legislation? I know there was legislation that was meant to force brokers to, disclose their commissions and how much money they were making on plans, and then that got pushed. There's a lot of brokers who pushed back. Is that still a thing that's going to come to market anytime soon, where there's going to be some more transparency for people in terms of what they're actually paying their broker?
Yeah, good question. That has been pushed back. It looked like there was going to be forced commission disclosure, but that is not in place right now. I don't believe that there's a firm date for that to come out. Brian might have some more insights on it as well. But right now, you might not be aware of what the advisor commission is built into the cost of your plan.
Well, the truth is that you might not be aware of all three of these things. Like me running into, learning about group benefits years ago, I had no idea what a TLR was. And I I was previously co-founder of another tech company years ago and was the guy paying for the plan. So, nobody told me, our broker didn't tell us. There's no concept of a TLR in my mind. And so understanding and asking what your TLR is, what that pooling fee is, asking your broker what their commission take is, you should know these three things absolutely when you're pricing out your plan or trying to save money right now.
Of course, yeah. And the point it really being is it's difficult to be strategic without having an understanding of the financial factors within the plan. Because performance rates are dependent on the claims experience, dependent on your credibility, and all of that stuff gets compared against those margins from the insurer, dictating your rates to fund the plan. So you can see that cost of insurance for those extended healthcare and dental is quite high. It's a pretty large margin. So in thinking about Brian's take around adequate paramedical coverage and being strategic, we should talk about healthcare spending accounts for a quick second and talk about that a bit more. So like Brian said, that HSA, it's simply an employer-funded account. It's a bucket of money that employees can claim towards those CRA-eligible health, dental, vision expenses. You can think of it really anything that would be included in a benefits plan anyways. It's giving employees the flexibility that they would likely, look and hope for and that they love, but the cost is controlled simply to the administration fee, which you can see a few on the screen, 10, 12, 15% as common examples, and that is charged only on claims that are made. So if you consider your paramedical coverage you might have in your plan, which is a maximum per practitioner, your vision, which is a maximum every 2 years typically, if you consider the cost of insurance you pay on those relative compared to a 10% administration fee on a healthcare spending account to fund them, it's a huge difference. So when the claims can only run so high for particular benefits, thinking vision and paramedicals again, the question is it really worth insuring those benefits and paying the cost of insurance, that margin, when the claims can only run so high? You don't necessarily need to insure them. Vision care claims can only run so high, for example. So fund those expenses through an efficient, flexible vehicle like the HSA. Only pay for what is used, eliminate the cost of insurance, give your employees flexibility. Really great strategy. So that's the stuff you're paying for. Consider the TLR, pooling fee, commissions, expenses, along with the bottom line price. And of course, people have questions, had increases or whatever, we'd love to chat. Happy to support you and your company during these times.
Coming back to the HSA coverage, I know that the fee structure is very typical. Some HSA providers, correct me if I'm wrong, because I'm not the expert, also might charge like a monthly fee or something like that. And how would that be? Is that usually offsetting as it relates to the administration fee?
Yeah, good question, Simon. So going back to Brian, it depends. Plans can be structured with either an administration fee, which is a percentage that's charged just on claims that are made, or you can structure them where you pay a set subscription fee each month, whether it's $10 per employee per month, for example, to have access to the healthcare spending account, and that's the only fee that you would pay for employees to have access to a healthcare spending account bucket that the business funds. So in comparing the cost subscription fee versus administration fee, often it comes down to, well, how large is your healthcare spending account and what's the average spend that employees are using it? Of course, the subscription fee, the break-even point tends to be better if employees have a very large healthcare spending care allotment because there's more dollars to spend, thus more administration fee percentage compared to a fixed subscription fee. However, if your healthcare spending account allotment is quite low relative to your benefits plan, then the administration fee can tend to shake out a little bit cheaper than a fixed subscription model.
We are running up against the end of sort of the hour here. Was there any more content that you wanted to get through before we jump in and try to answer some of the final questions?
No, that is the last slide. So timed it relatively well. But
well, we're not going to have a lot of time to get through questions here. I'll try to squeeze in one. But just as a reminder before everybody jumps to go to their next meeting, we are going to be sending around this deck. This recording is going to be available, and we are available, Brian mentioned it, brokers@humi.ca or benefits@humi.ca to answer questions. Whether you're a client or not, we're here to help. And with that said, I'll try to squeeze in one last question. There is some provinces are already starting to announce relief in terms of the lockdown. So, for instance, Saskatchewan's already starting to reduce, given their success with flattening the curve. They're starting to reduce the amount of lockdown. And as of today, I didn't know this, dental and paramedical facilities are going to be reopening. But a lot of carriers, national carriers, have provided relief, as you mentioned, for things like dental. Do you know if they're going to be making provincial updates? Like, I would expect that they would, but have they talked about treating anything on a province by province basis, or is it just a national, policy that they're putting in place?
So far, it's been a blanketed approach from as far as what I've been exposed to. I have not seen a province by province approach to this yet. If we see, let's say Saskatchewan's open for a month and no one else is, and we're inching closer to 2 months, who knows? Saskatchewan might take some measures. Regional specific carriers like a Saskatchewan Blue Cross might be able to accommodate something like that because they are a regional player. But again, we've seen the blanketed approach from carriers.
Yeah, that makes sense, just given the amount of administrative work. Okay, well, we do have a lot of other questions, but what we'll try to do is get back to everybody who didn't have their questions answered via email. And again, if you do have any more questions you want our team to answer, please, brokers@humi.ca, benefits@humi.ca. And thank you all for joining today. Thank you, Brian and Emmett, as well, for sharing your perspective, sharing your time. Hopefully we've helped people save some money or guide through this crazy time with the advice.
Thank you, everybody. Appreciate it.